Hello, and welcome to the Raise Capital Legally podcast and YouTube channel, your go-to source for insights on raising capital the right way. We dive into topics that matter most to real estate syndicators and fund managers with live Q&A opportunities before we wrap up. I'm Krisha Young, your co-host and business development director at Syndication Attorneys, and joining me is attorney Kim Lisa Taylor, the founder of Syndication Attorneys. Now, before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can go ahead and ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. Now, information discussed during this event is of a general and educational nature and should not be construed as legal advice. Now, today we are going to discuss some generally asked questions, misconceptions, myths, unknowns that we hear on our sales conversations from clients that come into our firm. Hey, Kim.
Hey, hi, Krisha. Hey, thanks for joining me today. And for all of you who joined to hear AJ Goyle about his medical practice, we're sorry that he wasn't able to attend. He is a physician and he had an emergency that he had to attend to. So we will go ahead and fill in the time with some of the things that we think are super important to you guys. Also, there's some pending legislation that could be a big deal. So we can touch on that. It's only partially through the process. Let's start though with Krisha. If you guys don't know Krisha very well, she's been with our firm now for a long time, and she is one of our most highly valued team members. She's our front line person, right? So we push Krisha out in front. She's the one you're going to talk to first. She'll introduce you to our products, to our services, to what we can offer as a firm. And she's also very, very knowledgeable. She's a mindset coach in her own right, and she's getting ready to publish a super exciting book.
Actually have it. Yes.
Yeah. So we're really glad that she's part of our team, and we always like to have you get to know her. And that's why she's one of our co-hosts on the podcast, but she's also an excellent interviewer. So we love her for her skills. But today we're going to turn the tables and we're going to interview her.
I love it. I love it. Thank you for that intro, Kim. It's such an honor being part of this team. I love it so much, and I think it's going on like 3 years now. So I don't know. I've kind of lost
Wow,
track of
that's
time, but
amazing.
yeah, yeah. And I'm so grateful for how much that you have taken my skill sets that I don't even know that I had and highlighted them. So I'm really grateful to be here. Thank you. And you're such a great leader.
Oh, thank you.
You got a mention in my appreciation in my book.
Oh,
You don't even know that.
okay. All right. So, Kusha,
Yeah.
you being the frontline person, you're seeing, you're hearing from the people that contact our firm. What is it that they, what are their concerns? What are their questions? What are the things that seem to be most, maybe confusing or just uncertainty? And
Yeah.
let's hear what some of those are.
Yeah. So I've made some notes here and I can run through the list and then we can pick whichever one we want to start with. But um, generally speaking, there's a lot of misinformation, I should say, or myths about what 506B means and what 506C means, and that, like, that some people don't understand that they're doing what's called a Reg D offering and that there's exemptions under that. They don't know the terminology. And then there's confusion about, well, I'm only raising from friends and family, so I'm not doing a securities offering. So what is a securities offering? So those are two questions there. I get asked a lot about timing. When's the right time to hire you guys? Like, I'm probably way too early, you know? Um, and a lot of people use the word fund in place of what we would call a specified offering or a syndicate. I do get asked about fund of funds quite a bit, actually. A lot of people think that that's a really easy way to go and raise capital. and what entities are needed. So I would say those are the top ones. I think we could fill the whole hour with that.
We can pretty much fill the whole hour with that.
Yeah.
But I do want to make a note of the pending legislation as well. Um, and I've been taking some notes here. Um, and I'm just trying to think if there's anything else. It'll come up in the course of conversation as far as other things that people are asking me about. But okay, so Rule 506B versus 506C, that's probably one I should answer. Okay, so Regulation D. So here's what it is. Let's start all the way back at the beginning. The Securities Act of 1933 came into being after the stock market crash that facilitated the Great Depression. And what it was about was protecting retail investors because a whole bunch of people had been swindled out of money. They lost all their savings and their money. And then they said, we didn't know there were risks. We didn't know that we could have lost our money. Nobody told us about this stuff. And so the Securities Act of 1933 was born, which defined what are securities and also what kind of information has to be provided in order to protect investors, and also made violations of securities violations became a federal crime. Prior to that, it was handled individually at the state level. So it became very easy for someone to commit fraud in one state and then hop over to another state and do it again. And the prior state didn't have jurisdiction over them. So when they made it a federal crime, then all of a sudden the SEC was born. Securities and Exchange Commission came shortly after the 1933 Securities Act, so that it could now take jurisdiction over all of these crimes and violations on a federal level. And so the Securities Act of 1933 is still alive and well. It has been modified many, many times. You can still look it up online. You can look at the current version and see what it says. But in the Securities Act of 1933 is a definition of what's a security. Because, I mean, common usage, security means, the cameras and
Right.
the Ring doorbell at your house, right?
Right. I
This
don't
is
even think
different.
about that. I'm so ingrained in what these types of securities are.
Yeah, and and it's a little bit different nomenclature also because we call them securities, not you can call a thing a security, but it's really a documentation. It's paperwork. It's an agreement. It's a contractual agreement between the person who's raising the capital and the people who are contributing the capital. It forms the framework for what kind of an agreement they're going to have with each other and what kind of promises they're making to each other within that contractual agreement that have to be honored. So in the case of real estate investors, there's several rules that apply, but the primary rules that people use is something called Regulation D, and underneath Regulation D are two subsections. One is called Rule 506B, and the other is 506C. So when new legislation is passed, this becomes the legislators say, okay, we want you to do this, and they then delegate that out to the appropriate agency or department that handles that. So the Securities and Exchange Commission is an actual commission that is tasked with then creating the set of rules that implement that thing that the legislators wanted passed. So if there's a new rule and they say, oh, we're going to raise the definition of accredited investors to, include these higher financial qualifications or whatever they say, or we're going to add some new provisions. Well, they're just going to hand that to the SEC and just say, do this. And then the SEC has first of all, there's a waiting period. They have to put everything out for, public review for a certain period of time. Usually, well, actually, I'm getting ahead of myself. The SEC then would have to implement the rules on how that, the actual specific procedures on what we're going to be looking for, what the specific rule is. And then before that can become final, they have to propose a rule. They have to put it out for public comment for at least 90 days. And then they have to assimilate the public comment into their final rule, and then they issue the final rule, and then that sits out on the Federal Register for a period of time before it becomes effectively law. So that whole process can take about a year. So just because the legislator said you can now do this doesn't mean you can immediately go do it. It means now the SEC has been tasked with creating the actual specific rules, and once those rules
Right.
are passed, then we can do it. Okay.
That makes
So
sense because you want to like they need to massage it. They need to see like how is this going to work if this then that, right? They need to apply it to like real life scenarios. So I can imagine it could take a while before they say, okay, yeah, rubber stamp it and now we're good to go. And then it goes out to the public, I guess.
well, and there's also big players that are going to be commenting on all of this stuff along the way. We've got FINRA, which is the self-regulatory agency for financial service industry, and they kind of serve in a quasi-government role where they do their own enforcements versus deferring everything back to the SEC, which has a lot of other jobs. And so there's, and then also the states. There's 50 securities division. There's actually more like 63 because there's one for every state plus every territory, Commonwealth, or any other
Oh,
U.S.
wow.
holding.
Okay.
So they all have their own set of rules. And even there's something called the North American um, Securities Administrators Association, NASAA, which also includes Mexico and Canada, and they all meet. And Canada has its own set of rules that are in sometimes very similar to ours, to our Regulation D, Rule 506. So it's kind of a long answer how legislation happens. um, the so the regulation was what the SEC created. We're going to create this regulation. Underneath this regulation, we're going to have a specific rule. There are multiple rules that you could raise money under. Rule 504. We don't hardly ever do Rule 504 offerings. You can do them. You can raise up to $5 million. I think the limit is, might even be 10. I just don't keep up with it because nobody ever wants to do it. Because then the reason they don't is because you still have to comply with all the individual state laws, and and you actually have to get state pre-approval. But then in some cases you can actually advertise. So most people don't want to do it because our clients come from a nationwide database. They go to these nationwide training events. They learn how to raise capital. They know people in many, many states. They don't want to try to limit it to 2 or 3 states that could review and approve it, and then they're just only can raise money in those states. So with the Rule 506 is more popular because it allows you to do that. It allows you to raise money from people anywhere in the United States. Doesn't restrict where you can raise money from, and it preempts all the individual state laws. So that just means that no state can say, oh, and by the way, they can't, the investors from our state can't invest more than 10% of their net worth or
Right.
something like that, in addition to whatever rules Rule 506B has in place. So originally there was just one Rule 506, and it came about because people were saying, why can't I go raise money from my family and friends? It was actually originally kind of called the country club rule, right? So somebody in the country club, hey, what are you investing in? Oh, I'm buying this multifamily property. And then their buddies are like, well, we want to do that.
Right.
And prior to the 1980s, when Rule 506 was born, there wasn't a way for anybody to be able to legally do that without going to the SEC, getting pre-approval, and getting their blessing, which is a long and expensive process. And they didn't have time to do that when they're trying to close on a property within 90 days. So that's when the SEC relented and said, okay, we'll create this rule that if you just do it word of mouth to people that you already know, who includes your friends, your family, your acquaintances, so, and you're not doing any kind of public advertising, then we'll allow you to do that with this close-knit group of people. Okay, so that's where the Rule 506B came from. So the actual rule um, is that there's no limit on how much money you can raise. There's no limit on how many accredited investors you can have in your deal, so you don't have to count accredited investors. And you're allowed to have up to 35 non-accredited but sophisticated investors, but you cannot find any investor through any means of general advertising or solicitation. So that means that you cannot put social media posts out. Of course, remember in the 80s when this came about, there was no such thing as social media advertising and email blasts and things like that. So, but at that point, you weren't allowed to advertise it in the newspaper or, on the radio or the media avenues that were available at that time. Well, now here comes the internet. Everything explodes. Everybody starts doing everything online. People start complaining, hey, why do I have to do this? But the way to prove that you didn't solicit to the public is to be able to demonstrate that you didn't talk about your deal. If it's a fund, you didn't talk about your fund. If it's a syndicate where you have a specific project under contract and you're offering specific returns, you didn't talk about that specific offering to anybody that you hadn't already established a pre-existing substantive relationship with. Okay. Pre-existing means it predated your offering. You had that relationship in place prior, but it also had to be substantive. Substantive means you had a conversation with that person, or you or someone on your team had a live conversation with that person and talked to them about their suitability. This is the SEC word, suitability, to participate in your offering. And what does suitability mean? It means how sophisticated are they? Do they meet the definition of an accredited investor? If not, are they sophisticated? There is a SEC definition for sophisticated. Do they meet that? And it's really, I like to simplify it to say it's more than somebody with savings and a job. They have to have some level of investing experience, maybe heavily invested in the stock market, owned their own real estate, investment real estate in the past, have owned businesses, own their own business now. They're a CPA, they're an attorney, they're a financial advisor, something or someone who's been through a training program on how to buy the asset class that you're buying, and they are looking, they're at that training program looking to meet other people that they can invest with. So, it has to be something more than just savings and a job. And they're going to tell you in their own words why they feel like they meet that definition. The true definition is someone who, with the help of their either on their own, the actual definition for you here.
Yeah, because they're going to be getting like a huge packet of documents that they need to like legal documents that they need to read, understand. But not only that, they're handing over money that it is at risk, hence why these laws are here. Like there is still a risk. Just because the law is here doesn't mean that there's no risk anymore, right? It's just like now you are made aware of the risk. You've signed your name on the fact that there's a risk, like you can invest this 100 grand or whatever it is, and you know that you might not get that back, maybe, you know. Um, but so you have to be sophisticated enough to understand that, right? Is
Well,
how
and
I
not
got
only that, it's more about, can you withstand the loss if it were to happen?
right.
Are you able to recover from that? You don't want to take somebody's last $50,000. You don't want them to depend on your returns to pay their bills. So that's part of what you're asking is this going to be something that you could even handle? And, if the worst were to happen, is it going to be financially devastating for you? Or are you going to be able to recover? So their true sophisticated rule is to be sophisticated, the investor must have either alone or with their purchaser representative such knowledge and experience in financial and business matters that they are capable of evaluating the merits and risks of the prospective investment. So back to what Krisha said, reading this pile of documents, understanding what it means, and the issuer's responsibility. So if you're the one promoting and offering and you're creating a company, that's going to be called the issuer of the securities. That issuer has it has a reasonable belief based on a factual inquiry that the non-accredited investor falls within this description.
Right.
Okay. So you give them the definition. Hey, this is the definition. Do you meet this? And then they'll say yes or no. If they say no, then you're not going to be able to help them with a Rule 506 offering. There are some other exemption types that we might be able to help you with. And then you will be able to determine whether or not, ask them, well, then how do you feel like you meet this definition? What is your background and experience? And,
Mhm.
where did you obtain that?
And you
And so
can't
they'll tell you.
feed them the information. You have to just like hear what they have to say and then write it down. Like you're not getting involved in sort of like guiding the people in any way, shape, or form in these
Well, and
conversations.
even when you're having the initial conversation, you can ask those questions and you should. But the third part of that pre-existing substantive relationship, okay, so one, they had to either be accredited or they had to be sophisticated, and you determined their suitability, whether they could withstand the loss. But you also want to talk to them about the kind of deals you do and the, kind of general returns you have and the duration to make sure that all matches their needs. So you have to decide whether their investment goals match yours. Somebody tells you, I only want to be in a deal for 2 years, then you don't want to put them in a property where you're going to own it for 5 to 7 years. It wouldn't be suitable for them. So you've got to figure out whether or not there's a place for them in your deal. And if there is, make sure that it matches their needs. But you also, then the third part of that, are they accredited? Are they sophisticated? They match those tests. Are they suitable? Yes. Then you have to have a record keeping system to prove that you had the conversation and what was discussed. So that you can say, no, I talked to them on March 13th and I didn't make the offer to them until April 1st. I didn't tell them about the deal. I just talked to them in general about their sophistication and whether they were accredited. So basically comes down to you have to know that information first and you have to have documented when that call occurred. The SEC does not believe that this can all happen through an exchange of forms, of electronic forms. Those aren't relationships, that's just data. And you have to actually have that conversation. During that conversation, the practical things, what that happens is you're going to get a sense of whether this is something that's right for this person, or if this is more like, is this somebody I want to do business with and have
Right.
them in deal for the next 5 years? Because if
Yeah.
you already are getting a distaste for things they're saying or the way they're saying things, or they act like they know more than you, or they seem like they, just might not be an agreeable investor in a group setting, then you would want to be able to rule them out just based on, I don't think this person's a good fit mentally or, psychologically, or just not a good fit for
Yeah.
me because I don't like them. You
That's
know,
important. And that, well,
it's
that's
huge.
important because, especially when you're just, if you are doing a C offering, which we haven't yet talked about, but where you're just doing that general solicitation, you're just like, hey, anybody come into my deal or whatever, as long as you're accredited, there's still a relationship that needs to get developed there because you're going to be in business with this person for a long time, for a long time. So I think you want to have like any business, like any kind of customer, like anybody that's in your sphere, you want to like vet them to a point where you're like, okay, yeah, I can work with this person, you know, and they're not like giving you the ick or, you know, if they have like a blaming type personality or something like that, you'd want to like steer clear of that, I think.
Well, and one of your suitability questions might be, have you ever been in a deal that went bad? What happened? And if they start talking about, oh, I sued this guy and I sued that guy and I'm in 7 different lawsuits, well, maybe you don't want to
Yeah.
be in business with that person.
And you're like, thanks for letting me know. Good luck with that. Bye.
Yeah. Um, and it doesn't mean that things don't go wrong. I mean, how many marriages fail, right? That's kind of
Right.
a
Yeah.
partnership too. But and there are some statistics out there that say that somewhere like 50 to 70% of partnerships fail, but largely they fail because there wasn't a meeting of minds in the beginning and probably not clear documentation on who did what, who got what, and
Right.
and then also holding each other accountable and actually paying attention to what each other are doing and making sure that nobody's taking advantage or doing something they shouldn't be, stopping them early. Okay, you got
So
to stop people early. So
well, that brings me to the question though, like the one that people are asking. I know we still need to talk about C, but um, I'm just raising money from my friends. I'm just raising money from my family, or I've just raised money from friends and family, and now I'm ready to do a securities offering. That's still a securities offering. This is literally called the friends and family, right? And
yeah,
so even
exactly.
with that, so there's like this other thing that like it's still a securities though, even if it is your bestie that you're raising
Yeah.
from.
That's right. That's right. And you know what? It's not the people that you know that are going to cause you trouble because you could, hey, this is my golf buddy. I've known him for 25 years, or it's my next door neighbor, whatever it is, but it's not them that you have to worry about. It's what if something happens to them? You don't have a relationship with their heirs. And in their heirs' mind, hey, this person has my parents' money, we want it back, and or they get a divorce and the the interests in your LLC go to the spouse, and the original person but not the spouse, and the spouse again may just have a different idea of, okay, I'm just going to cash out all his investments or her investments and live on the cash. So you've got to guard yourself against the unexpected, both on the management team side, making sure you're prepared for it within your own group. And if you're a sole syndicator, you've got to have some kind of a continuity plan in case something happens to you. The
Right.
same thing is you want to know, that your investors are reasonable and that you are protected in the event that something happens. Somebody else gets control of that investment. Could be a bankruptcy trustee who, again, they just want the money and they start pressuring you to give them the money when you don't have, you're in the middle of a deal, you don't have the money, you can't give it back. So we've got to make sure that we've guarded you against that stuff.
Mhm.
And all right, so let's cover 506C. I know we've belabored this quite a bit. Let's kind of get through it. Everybody complained in 2012 saying, hey, why, this is the age of the internet. Everybody's advertising on the internet. This is ridiculous. We should be able to post our deals online, do them. And the SEC said, okay. And we will create a new rule called Reg D Rule 506C. So we've just kind of divided 506 into friends, family, and acquaintances, pre-existing relationships required, no advertising. And now we're going to give you, slice out a piece of it and say, okay, this, if you do it just this way, you can do the advertising. You can use online advertising. And so 506C says you can still use the Rule 506 exemption. There's no limit on how much money you can raise, but you can no longer, if you're going to advertise, have non-accredited investors. Everybody has to prove that they're accredited. So in the 506B setting, they can just fill out a form at the time they make the investment. So you're going to have the conversation with them prior. They don't have to fill out a form then. You need to
Right.
keep a record. You can have them fill out a form, but it's kind of extraneous at that point. You're just having the conversation, you're documenting the conversation, what was said, keeping it in your own internal record keeping system. And then for 506C, you don't have to have that now, but the investor has to prove by providing you with a letter from someone with, technically not, it's not absolute required, but the guidance is get it from somebody with a license, attorney, CPA, financial advisor. If they are accredited, there's a good chance they already have people in their world that can write this letter for them. Although I know my CPA is like, oh, I can't write comfort letters. It's not out, it's not my, insurance. So you might have to go to a company that actually does that. Um, so CPA, attorney, financial advisor, these third parties, we've got one through our website that you can go to Get Verified tab, and your investors can go there, Get Verified. We don't get their information. It all goes directly to the third party that we've contracted with, who does those verifications, sends the information directly to either the issuer or to the investor. They provide it to you. Um, so there's plenty of those out there that will do it for under $100. It's just a little extra step for the investor to go through if they don't have their own person, because they've got to provide their financial statements or their income statements to somebody to prove they're accredited. somebody is out here might be saying, well, they keep talking about accredited. What does that mean? It means they have over $1 million net worth, excluding equity in their primary residence, or over $200,000 a year income if they're single, or 300,000 a year if they are cohabitating couple. And that income has to have been for the last 2 years with the expectation it will continue indefinitely into the future. So you need, so I just call it 1 2 3 rule. $1 million net worth, 200,000 income single, 300,000 if they're a couple. And if you just kind of keep that in mind, then you'll know. There are some additional hoops you have to jump through if you're going to do a 506B offering that you don't necessarily have to do for a C. There are some financial statements that you need to periodically provide. Even if you have a zero balance in your bank account, you've got to provide a statement saying, hey, we put $1,000 in the bank account to open it and we haven't done anything with it. Here's what we provide to the investors up until the time we close on the property. And then after you close on the property, you need to update that and tell them what actually happened. And you need to keep that current. It's every 120 days, but a better practice would be just to update it every 90 days as long as you're raising money. So as long as you're raising money. If you have non-accredited investors, you can also incur an audit obligation. So you would have to have your financials audited, which is going to be very costly, $20,000 or $30,000. It's going to take up a lot of your time. So how that happens is the audit obligation comes into play at the end of the first fiscal year of your offering. So you have to be cautious about what you choose as the end of your fiscal year. If you start an offering in October and you just kind of default choose December 31st as your end of your fiscal year, then at start of January, you're obligated to incur an audit to produce an audited financials if you're going to continue raising money from non-accredited investors. Okay. So if you can either limit the time that non-accredited investors will be accepted to within the first fiscal year, or you can start providing audits and continue raising beyond the end of that fiscal year. So we've got an article about that on our website. If you'd like to look that up, that would be really helpful for you to know. But yeah, so there are additional hoops you have to jump through. You've got to give, some biographical information about your track record, your background, and you should be providing the same information even in a 506C offering. But you don't incur an audit obligation in a 506C offering. I would argue that those relationship building steps, that suitability conversation should be had with every single investor, regardless of whether it's a B or a C, because that's the only way you're going to know whether you really want this person in your deal. There's a whole lot of people out there that have money that probably have no business investing in these types of deals because they're distrustful. They just like to do their own thing. They want to be running the show themselves. It's just the nature of people. Some of them are suitable, some of them are not. So think carefully about that. If you have that conversation with every single person, then you're going to have a pretty good feel of who you're letting in to your life for the next 5 to 7 years. And if you vet them carefully enough, then you won't be letting people into your life that could be troublesome. So,
Yeah, this is such a huge topic, and thank you for all of that. It's so big that I mean, like we have articles on this. We have 2 books that people can
mhm,
go and grab that will tell you more about this. But also, we talk about this almost every single week on our mastermind
we
too,
do.
and we
We do.
have a mix of people in our weekly. We've got a weekly clients only mastermind. And that anybody watching, if you're not a member of that, you can contact me and I can talk to you more about how you get enrolled in that. But every single week, even with what we call like the legends, so we have some clients who have done multiple deals. They've been with us for many years. They've been raising capital for a really long time, who show up every week and still raise their hand and still ask questions. And then we have people who've never raised capital before. That's why we call it the syndication program is because, a lot of people just haven't done it yet. And so they're learning about this, right? While they're going out there and they're practicing having these conversations with investors. And, I've heard you say many times, generally speaking, that, just even if you're doing a 506C offering, to like follow the B guidelines anyway as best practice, right? Like it's just it covers you in a really deep way, even if you are doing a C offering.
All right, well, let's go on to one of your next questions because I think it all ties into what we just talked about.
Yeah,
How do I know if I'm selling securities? How do I know if I'm selling securities?
right.
Well,
Yeah, that because that's the one. Well, it's only friends and family. Like
yeah.
it's yeah.
So those things that we just talked about, Regulation D, Rule 506B and C, are um, derived from the Securities Act of 1933. And what the Securities Act of 1933 said is if you're selling securities, you either have to register your offering, which is getting pre-approval from the SEC before you offer it to anybody. So that's what happens with an initial public offering or when a company goes public. That is called registration. Or if you don't have time or it's not the kind of offering that you can afford to go through the registration process, then you have to qualify for an exemption from registration. And that's exactly what Regulation D provides. Regulation D provides these exemptions. We mentioned 504, 506 B, and 506C.
Mhm.
506B is by far the most common exemption used. The SEC receives filings, so there's a form we have to file with the SEC telling them which exemption you're claiming, and then you have to provide the documentation if a regulator or opposing counsel from an investor dispute ever asks for it. You have to provide the documentation as to how you followed it. So I always say, think of this like a tax deduction. If you have the documentation to back up the deduction you claimed on your tax returns, you're self-reporting, then you are entitled to keep it. But if you're audited and you can't produce that documentation, then you don't get that deduction. There's going to be penalties, there's going to be interest, and in the case of an IRS violation, you're just going to get penalties and interest. But in the case of a securities violation, you could get a regulatory investigation. It could become a really big, ugly, horrendous defense. And so you want to guard against that just by following the rules. The rules aren't that hard. You need to get to
Yeah.
know those rules. But 506B is the most common. The SEC estimates that out of the 25,000 Form Ds that are filed every year, that 90% of them are 506B offerings, and 95% of the capital raised in 506 offerings is through 506B. So 506C is still available to you, but you can advertise to everybody, but the only people that can invest are verified accredited investors. They have to provide documentation that they're accredited before you accept their investment. So they can send you the money, you just don't admit them to your company until you've looked at that verification. You need to make sure that the verification letter they provided matches their subscription agreement. The companies are the same. The check is coming from the same company's bank account. All of that stuff has to jive. And if it does, then you can accept them as an accredited investor. Now, there are investor management platforms out there. Our friends at Cashflow Portal and InvestNext are excellent at helping you gather that information. And they even have places where your investors can log in, get their own account in order to invest with you. You can post all your documents. The investors go there in a secure location. They can then actually get verified as accredited through those portals, and then that information comes back to you and stays in their record. So if you're going to be doing this, it's a good idea to consider one of these investor management platforms.
Hmm.
Our clients love these two, Cashflow Portal and InvestNext. They love them both. And, we just can't say enough about how easy they've made it, not only for you to uh, document whether somebody's accredited or not, but also these suitability conversations, because they all have a CRM built in, a customer relations management software, where you can keep track of phone conversations you've had and what was said, and that becomes that record keeping system that the SEC requires when you're determining whether somebody is accredited or not accredited. In the 506B offering, investors are going to sign a subscription agreement at the time they make the investment that certifies to you, in their own words, that they do meet one of those definitions. If they're sophisticated, they'll say why. You'll review that. As long as you think it's acceptable, then and consistent with what you know about them from your prior conversations, then you will admit them. If anything is off, you don't want to admit them. Or if they don't, here's one of the bigger mistakes that a lot of clients make, is they don't review the subscription agreements. And then you start looking at the subscription agreements, and the person never answered the question whether they were accredited, or never answered the question whether they were sophisticated.
Yeah.
And then that's going to become a big ugly issue later on. If there's a regulatory investigation, they're going to say, you didn't know whether these people were accredited or sophisticated. You had no business admitting them. So you
So
got
I
to be
think you have to be careful, yeah. And so I think like there's two things going on here when you're raising capital for real estate or whatever. There's the business side of the real estate side of things where you're property managing or hiring out a property manager or whatever, but you're overseeing the actual real estate business of that. But then there's this whole security side that you can't be ignorant at. You need to understand it. You need to understand the documents. You need to dot your I's and cross your T's for both of those businesses, right? And so generally like that's a lot of work, right, for one person. So sometimes partnering, I've heard you say that a lot. Finding good partners or whatnot in your deals can help like kind of um, make them go better, for
Yeah.
lack of good grammar.
Well, and you need to, think of every time you're starting a new, and let's go into your next question. You said there was some confusion about terminology. What's the difference between a fund and a
Yeah.
syndicate? Well, a lot of people just generically use, a lot of trainers. There's people out there training people how to raise capital. We've got a few good friends that we know who are doing this. One of them is Tim Mai is been doing it for a while. He's actually kind of integrating into the RE Mentor program, and going to be, facilitating some of his training through that. There's also Marcin Droz. He has his M1 Capital program. So they have a coaching program teaching people how to raise capital, and also Hunter Thompson. So these are people that we've known. I don't know Tim as well as Hunter and Marcin, but they all have been out there for a while teaching people how to raise capital. And so if you need some coaching in that area, or want some coaching in that area, that's a good place to go. So fund versus syndicate. So you may hear from them, they may be just saying fund, go raise a fund. But when you get to us, we're going to try to parse that down and say, well, what do you mean? What are you raising capital for? What is it for one thing? Is it for multiple things? Are they just, multiple things that are like each other? Are you just going to be buying the same asset class over and over? Do you want to have all investors, if you're going to buy multiple things, do you want all your investors pooled in one entity, and then that entity goes out and owns those multiple things? Or do you want to have some kind of a separation between investors and properties, so that you have a separate group of investors for each property? And so there's different structures that can be used for that. Or are you going to invest in somebody else's deals? And are you going to do it in a way where you'd like to isolate the investors that say, yes, I'd like to invest in that specific deal, from other people in your fund? So there's really kind of four different types. I'm not going to spend a whole lot of time going over this, because as Krisha said, we could spend the whole time just talking about deal structuring, and maybe we will do that at some point.
Yeah.
Let us know if you'd like us to do that. But
Mhm.
so blind pool fund, that's well, let's start with syndicate. A syndicate is the simplest thing, it's where most people start. A syndicate is what we also call a specified offering. You have something specific under contract that you're raising money for right now. And so you're estimating I'm gonna get a bank loan for 70 or 75% of the purchase price, and then I need to pay all these other things. So you're going to create a whole uses of funds. This is called a sources and uses of funds. Where's the money coming from? How is it going to be spent in order to acquire the property? And to implement your business plan for the property. So this doesn't go into cash that you're getting from operations of the company. It's just how much money do I need to raise up front? So the things you need to raise money for: down payment, closing costs on a property, the acquisition fee for your asset management team, the capital improvement budget for whatever you want to be able to do to that property. So if it's a development project, well, it's your whole construction budget. If it's a value add project, it's what are the costs for the renovations, estimated costs for the renovations. Then you're going to have some upfront bank processing fees. They're going to charge you some upfront fees to do their due diligence on your deal and to look at all your asset management team's financials and determine who's going to be the guarantors. They're going to look at all of that, and they're going to charge you some upfront fees for that. So all of those things plus our legal fees. Our work has to be done before you can raise any money. So we ask for our payment up front so that we can get your stuff done as quickly as possible so that you can go out and start raising capital. So that's a syndicate is one thing. That's your uses of funds. Your sources of funds are going to be bank loan, maybe seller financing if you have it. If not, you're just going to have two line items there: bank loan, cash raised from investors. If you have seller financing, you'll just add a third line to that sources of funds, or seller credit that goes into the sources of funds. And then your uses of funds is all the things you need to spend the money on to get the property, plus some operating capital and reserves. And then that number has to match your sources of funds. That's how you determine how much you're going to need to raise from investors. Well, now you know that number, then you're able to do some further financial projections about cash flow and income and expenses over the period you plan to keep it in, plus your potential exit strategies. I'm not going to get into that either because that in itself is a
It's
whole
a whole other topic.
class. Yeah, but so that's a syndicate. One thing, and maybe even have two things. Maybe it's two properties side by side. You're going to get separate loans. It's okay, but you're going to have one pool of investors. It's still specified. You know what those things are. You can determine the actual costs, or at least the estimated costs. The second thing is a fund. Okay, in a fund, you don't have anything under contract. You just have a business plan. We call it an investment summary. The investment summary describes what kind of properties you're buying, what geographic areas, what criteria they have to meet, what kind of due diligence you're going to do to protect the investors, and any kind of proposed returns or anything like that you might do. So that's what a blind pool fund is. Okay, syndicate, easiest way to raise money. Blind pool fund, hardest way to raise money. What will increase your odds of raising money with a blind pool fund? Bringing somebody on your team that already has significant experience with the asset class you're trying to buy, or actually having a track record. So having done 5 or 6 syndicates with your team, and then your team decides, okay, now we're going to do a blind pool fund. Instead of buying one property, we're going to buy 5. And with this one pool of investors. So when we hear fund, we think blind pool fund. We're always trying to, determine from you whether that means the same thing to you as it does us, because you may be calling a fund what we call a syndicate. So a lot of our Kris's initial calls are just trying to determine what it is you're doing. And the way we do that is we just ask you, don't tell us what you're doing or what kind of legal structure you want to use or what exemption, none of that. Just tell us what you want to do. What are you raising money for? Are you raising money from non-accredited investors as well as accredited investors? That's going to help us determine what the the exemption you're going to use, and then how do you want to structure this? So there's another structure. What if we want to just keep buying the same thing over and over, but we want to isolate investors and properties into one, separate groups? Well, then we can do what we call a series LLC, where we create a master LLC that says, hey, we're going to go out and buy a bunch of self-storage facilities, and we're going to create a separate series for each group, each one, and with separate investors in each one. When we get another one on our contract, we're going to do another. Each series is created as if it were a separate securities offering. So we'll pick for the master. Are you doing 506B offerings or 506C? And then you're going to continue with that whole series with that exemption. There is an exception where if you run out of non-accredited investors at some point in time, you still can only have 35 across all the series. You could at that point convert to a 506C, and from that point on, you can begin advertising. But you can't go back and forth for each deal. That's a question we get a lot.
Yeah, I get that
And
question
then
too. Can you convert from a B to a C? Yeah, that's another one.
you
Yeah.
can convert from a B to a C. It's harder to go back, and you can't flip flop. So it's harder to go back from a C to a B because you have to stop raising money for 30 days, and then you can start your B offering. Well, if you're in the middle of a deal, you don't have time for that if it's got a 90-day close. So easier to go from B and then convert to C. You can do that immediately, but we do have to reissue PPM and the subscription agreement for the C offering. It's different than the B, and you would, from that point forward, not be able to accept any
No.
previous non-accredited investors you talk to. And then there's the fund of funds, or it doesn't matter. Fund of funds just means you're not going out and buying your own deals. You're investing in other people's deals, and you're bringing your investors in your own group. It can get a bit complicated. There are a lot of people that don't think it's complicated, but unfortunately, it is the most complicated way you can raise money. There is something that has been created in the industry we call it a flex fund. Cash Flow Portal calls it a flexible fund. I think Avestor calls it a customizable fund. What it really is we're creating one fund, and then we're isolating the investment opportunities by providing, hey, here's an investment opportunity. You, investor in our fund, would you like to allocate some of your investment or all of your investment to this specific investment opportunity? And so we would create for each opportunity an investment opportunity summary that includes a supplement to the PPM talking about specific risks of that deal, how that deal is structured, what you're offering those investors, and a subscription agreement amendment where they clearly designate, I want this much of my money to go to this deal. I've reviewed everything I need to. And you're also going to be providing them with all of the offering documents for that deal you're investing in, so that they have a complete understanding of what their investment is being put in. So it's a lot more work in some ways for you because you have to gather the offering documents from the other people. You're doing your own securities offering, and now you have to further get these investors to designate a portion of their funds towards this specific thing. The other thing I would caution you against is if you don't understand underwriting deals, this is really dangerous territory because you have to understand and be able to, vet every deal that you're offering to your investors yourself to make sure it's a good deal. And if you haven't done that and that deal then fails, then you could be easily held negligent for not having done that correctly.
Wow.
So I think we've kind of talked about, the entities are all going to depend. Are you doing the blind pool fund? Are you going to do a syndicate? Are you going to do a series offering? Or are you going to do one of our flex funds? The entities will be slightly different for each one. They're all basically, pretty much have the same basic foundation. And I do want to, I know we've only got 4 minutes or so. Do we have any questions, Krisha?
Um, Nothing in the Q&A. Just James, will you put the platforms in the chat? Yes, I can do that.
Okay, so let's just spend the last 4 minutes talking about the Invest Act. So the Invest Act just went through the House, has not yet been to Senate. It has, let me see if I can get you the link to that. Let's see.
While you're looking, for anybody here live, I've put the trusted referrals or our vendors tab, and that's where you can find InvestNext, Cash Flow Portal, and anyone else that we refer our clients to. And I also put an article in there, how to create a substantive relationship, that is found on our website, just to round out the discussion and the information about a 506B offering and what to do. And we cover
Yeah.
a lot of this in our mastermind too, in our books.
And I mentioned underwriting, and so one of our preferred vendors, in fact, one of the top one on our list is commercial underwriting. It's a Bob Bowman is the proprietor of that. He's created a commercial underwriting software that will work with any asset class, and it comes with a tremendous amount of support and training. Bob and his wife Diane are very, very knowledgeable in the commercial real estate investing space. They've invested in a lot of different commercial asset types themselves, as well as taught it for years. And so if you're maybe with one of those capital raising coaches and you feel like, well, they're not really teaching me the underwriting part of it, which is where you're usually getting that from, some kind of a real estate training program, then you may want to check out Bob's commercial underwriting. If you go from our trusted vendor page to any of these links, they will offer you a discount. We always try to negotiate a discount for our clients to go there.
Yeah.
Uh,
And we
so
interviewed Bob too recently, so it's also in the last
in our podcast, we've interviewed
podcast.
Perry
Yeah.
Zhang from Cashflow Portal.
Yep.
I don't know if we've interviewed
I
InvestNext,
don't think we have.
uh, but we know them, and they're reputable people and absolutely loved by some of our clients. All right, let's talk quick about the Invest Act. So this is HR 3383, called the Incentives, New Ventures, and Economic Strength Through Capital Formation. It's funny what words they try to put together to write out the acronym they want, the Invest Act. So nobody ever knows it by anything except the acronym. But anyway, so it's been floating around there for years and years. It's actually finally getting some traction now. So this is a good thing. Title One is called Expanding Access to Capital for Small Businesses. So it really kind of caters to people who are raising for small business, not necessarily as helpful for people who are doing real estate. Title II, though, talks about increasing opportunities for investors. And I did just put the link to that summary. Then also, you could go online and you can find the full text if you like. Just realize it's not fully implemented yet. It could still change when it goes through the Senate. There's, certainly it could change substantially. So don't get too excited about it. Just kind of be aware that it's on the horizon. And if it does pass, it's going to be a big deal.
Mhm. So you
But
still have
Title
to follow
II,
the law as it is today.
yes.
Yeah.
And again, even if this legislation passes, it still has to go through the whole regulation
SEC
or
for a
and
year.
regulation creation and rulemaking process. And they've
Right.
actually, if it passes, SEC has a year to implement it.
Right.
So you still wouldn't be able to do it for a full year. But the Title II, increasing opportunities for investors, includes expanding the definition of accredited investor to include inflation adjusted net worth and income tests. So that could all of a sudden not be such a great thing, because no longer might it be $1 million worth of net worth. It could be three or something else. There was a report that came out last year that said if the criteria used when the rule was originated was applied today, 10% of the population at that point was considered to be accredited. And if we were to apply those rules today, it would be a $3 million net worth test, and the income requirements would be like 360 or 600,000, something. It was a lot more than
Yeah.
what people have had to do so far.
Mhm.
But it could allow certain licensed professionals and individuals with qualifying education or experience. So maybe open it up to attorneys, to CPAs, other financial professionals that might qualify just by virtue of their profession. It also could requires SEC to establish an exam program for people who want to test to become accredited. Those who pass the exam could be accredited. There is also a senior investor task force who is going to be used to study and report on issues affecting investors over 65. So there we might see some limitations on who can invest over the age of 65, and maybe they have some different criteria.
Wow.
And then also improving disclosure for investors. So that allows electronic delivery of documents, but excuse me. So some certain rules that would go into place regarding that. We don't know what those would be. And then also expanding closed-end investment companies' ability to invest in private funds. This is a little different because there's a whole regulation around somebody who wants to become an investment company, which is a completely different set of criteria from what you guys are following now. So just keep an eye on this. It's, really designed to help kind of facilitate the private markets and capital raising and that individuals can participate in. So it could be a big deal. And we will, of course, keep you informed.
Yeah,
And
well, definitely on our newsletter, I'm sure.
yeah,
But for sure in our mastermind too.
yeah. And so
Yeah.
sorry for all of you who came on to see AJ. He had an emergency, wasn't able to participate today. But Krisha, I think this has been tremendous.
I think this
I
has
think
been
it's
great.
information that we know our audience likes to hear. And the more you
Hmm.
hear it, the more it starts to gel. If you want to even gel it further, go on our website. And if you haven't already gotten one of our books, How to Raise Capital for Real Estate Legally is the second book I wrote. It's a little bit more encyclopedic. The first book I wrote is How to Legally Raise Private Money. It's kind of a step-by-step guide for syndication, shorter read, about half as long. So, if you look up my name, Kim Lisa Taylor, on Amazon, then you can get those books will pop up, and you can decide whether to get one or both of them. But maybe you want to read it on Kindle instead of getting, a PDF version or something. Then that would be a way to go. But yeah, I suggest everybody who's in the capital raising business have this one on their desk as a reference.
Yeah.
Uh, we would
The
love to have you have that.
the big guy, the big guns. This one.
Yep. And
Yeah.
it's going to tell you all about the things that we just talked about as well. So thanks so
Yep.
much for coming today.
Yeah,
We
thank you
appreciate all of
everybody.
you.
We had a nice attendees,
Yeah.
a healthy number, so that's amazing. And I put all of the links in the chat. My email, if anybody wants to reach out, is Krisha, Krisha, at syndicationattorneys, .com. Thank you,
Yeah, and
Kim.
if you want to get a paid consult with me or with Jason Hargadon, our business attorney, those links are there as well. Just go to syndicationattorneys.com and click on the schedule a consultation. And you'll see some
Yeah,
options there. But Krisha is always our front line. She can help steer you in the right direction, and she gets a
I
lot of really
try.
great reviews. So,
Yeah.
anyway,
Yes, thank
all
you,
right,
everybody.
all right. Thank
All right,
you.
thanks all. Bye.
Have a great day.
Bye.